trillion. That's what China is reporting as its trade surplus tonight with the United States.
It clocked its highest ever trade surplus in 2025. This as its exports grew over 5%.
China's paying a 104% tariff.
When Donald Trump returned to the White House, he promised something familiar. Once again, he said tariffs would tame China. Once again, he claimed America would force the world's largest manufacturing machine to slow down, submit, or break. But while the rhetoric grew louder, the numbers coming out of Beijing were moving in the opposite direction, quietly, steadily, and far more decisively. By the end of 2025, China had recorded an export surplus of nearly $1.2 trillion, the largest in its history. A figure so large it rivaled the entire GDP of a top 20 global economy like Saudi Arabia. It was not a projection, not an estimate, but confirmed customs data, and it landed like a shockwave because it arrived at the very moment Trump was escalating pressure, not easing it. This was supposed to be the era of restraint. Trump's renewed administration was openly committed to slowing China's production engine, shifting U.S. orders elsewhere, and reviving American manufacturing through punishment tariffs. Instead, China produced its strongest export run ever, not despite Trump's strategy, but while bracing for years more of it. The first thing the surplus exposed was resilience. Since Trump's return to power the previous January, tariff tensions had not faded. They hardened. Duties remained high. Threats escalated. And yet, Chinese exporters did not retreat. They reorganized. Firms pivoted aggressively toward Southeast Asia, Africa, and Latin America, regions that had been strategically cultivated for years but now became central pillars of survival. China's leadership made no secret of the urgency. Domestic demand was weak. The property sector remained stuck in a prolonged slump. Consumer confidence was fragile. Exports were no longer just growth. They were oxygen, and Beijing leaned into them with precision. By December, outbound shipments from China were growing at 6.6% year-on-year, accelerating from November's already strong 5.9%. Economists surveyed by Reuters had expected barely half that pace. Imports rose as well, climbing 5.7%, beating forecasts and signaling that trade activity across the board was stronger than anticipated. The message was unmistakable. Tariffs had not strangled China's trade engine. They had forced it to evolve. Behind the headline, surplus was a deeper structural shift. China was no longer relying on one market to absorb its output. The United States mattered less than it once did, not ideologically, but mathematically. Exports to the U.S. collapsed 20% in dollar terms, and imports from America fell nearly 15%. Trump's policies did succeed in shrinking bilateral trade, but they failed to shrink China's global footprint. While U.S.-bound shipments dropped, Chinese exports surged elsewhere. Shipments to Africa jumped 25.8%. Exports to Southeast Asia's ASEAN bloc climbed 13.4%. Even the European Union, often critical of China's industrial overcapacity, absorbed 8.4% more Chinese goods. Month after month, China's trade surpluses exceeded $100 billion, something that happened 7 times in a single year, up from just once the year before. This was not accidental. A weakened yuan helped pricing. State coordination helped logistics. But most importantly, diversification worked. By the time Trump spoke of new tariffs, China's exporters were no longer standing in the same place they had been hit before. At a press briefing in Beijing, Customs Vice Minister Wang Jun struck a careful tone. He acknowledged that global trade momentum remained weak and the external environment was severe and complex. But then came the key line. With more diversified trading partners, China's ability to withstand risk had been significantly enhanced. The fundamentals, he said, remained solid. Markets believed him. The yuan held steady. Equity investors pushed Shanghai's main indexes up more than 1% after the data release. This was not the reaction of an economy under siege. It was the reaction of one that had adjusted its stance and regained balance. For Trump, the optics were damaging. His tariff doctrine was built on the idea of leverage, that America's market was too large for China to replace. That assumption no longer held. The data showed that China could lose the U.S. market share and still grow exports overall. That single reality undercut years of political messaging. Economists were blunt. Strong exports, they said, were compensating for weak domestic demand. Combined with rising stock markets and relatively stable U.S.-China relations, Beijing had little incentive to radically shift macro policy in the near term. In other words, the pressure Trump applied was not forcing emergency responses. It was being absorbed. Nowhere was this more visible than in manufacturing. China's factories didn't just survive, they expanded reach. Over the year, the country's auto industry became a flagship example of Beijing's industrial ambition. Total vehicle exports jumped 19.4%, reaching 5.79 million units. Pure electric vehicle shipments surged nearly 49%. For the third year running, China was on track to remain the world's top auto exporter, overtaking Japan and redefining the global car market. This growth came with consequences. Trading partners grew uneasy. Governments worried about over-reliance on Chinese supply chains. Beijing itself began to acknowledge the image problem created by outsized exports. Premier Li Qiang publicly called for a more balanced approach, urging expanded imports alongside exports. Subsidy-like tax rebates for the solar industry were scrapped. Trade laws were revised at unusual speed to signal openness to global partners. But none of this erased the central fact. Trump's tariffs had not delivered the slowdown he promised. Even with U.S. duties averaging 47.5%, well above levels analysts say allow Chinese firms to export profitably. Production adapted. Companies shifted operations overseas. Manufacturing hubs emerged in lower tariff jurisdictions. Chinese capital stayed involved even when factories moved geographically. Trump continued to frame tariffs as unfinished business, hinting China could still be forced to open its markets. But the trade data suggested something far more sobering. The era when tariffs alone could dictate outcomes was over. By the end of 2025, the scoreboard was clear. The U.S. had curtailed direct trade with China, but China had widened its trade with the world. And that reality set the stage for what comes next. What made the numbers even more uncomfortable for Donald Trump was not just their size, but their timing. This surplus was recorded while his administration was actively preparing the ground for tougher trade moves. Tariffs were already high, threats were already public. And yet, China's export engine was accelerating, not slowing. Trump's strategy had always depended on one core belief, that the United States could bend global trade by force of access, shut the door, raise the cost, and the factory floors in China would go quiet. But by 2025, that leverage had weakened. The world had changed, and China had changed faster. Even as Trump talked about reopening markets and warned countries against trading with U.S. adversaries like Iran, Chinese firms were already operating in a parallel system. Overseas production hubs allowed them to ship goods into the U.S. and Europe through lower tariff routes. Supply chains no longer ran in straight lines. They curved around obstacles. Tariffs became friction, not barriers. This is why Trump's tariffs barely dented China's broader trade with the world. Yes, exports to the U.S. fell sharply, but global market share continued to rise. The surplus proved that China didn't need American demand to grow. It needed volume, flexibility, and reach, and it had all three. There was also a political miscalculation. Trump assumed pressure would force Beijing to the table on American terms. Instead, Beijing used the pressure to justify deeper industrial coordination at home and stronger trade ties abroad. Export growth became a stabilizer, shielding the economy from weak property markets and sluggish consumption. In effect, Trump's tariffs strengthened the role exports played in China's survival strategy. Even the supposed ceiling, profitability, failed to hold. Analysts warned that U.S. duties above 35% would make exports unviable, yet firms kept shipping, supported by scale, subsidies, currency dynamics, and alternative routing. The 47.5% tariff level did not stop trade. It reshaped it. By the time Trump was threatening new measures, China had already learned how to live with the old ones. This leaves Trump facing a harsher reality than during his first term. Tariffs are no longer shocking. Markets have adjusted. China has diversified, and global demand has fragmented. Repeating the same tactic now risks delivering the same result: disruption for U.S. consumers, headlines for politics, and adaptation for China. The surplus figure is not just an economic statistic, it is a verdict on a strategy. It shows that slowing China's production powerhouse requires more than punishment. It requires alternatives, investment, and long-term planning, areas where tariffs alone fall short. Trump may still promise to win the trade war, but the data from Beijing tells a quieter, colder story. One where pressure did not break the system, it trained it. And as the next phase of economic confrontation approaches, the question is no longer whether tariffs failed once. It is whether repeating them will fail even faster.
Free audio post-production by alphonic.com.